All right, guys, we made it. Yeah, sorry about that. I had to restart the computer, but now everything looks good to go. Last thing you want to do is be live and have the feed be terrible. So sometimes that'll take a minute. Made a joke today about maybe sometimes I'm outside with the bees and it was just bad timing. Most of the time, we're only a couple minutes late at worst, but today, a little bit later. But we got a lot to talk about, so we just want to turn it on and get right into it. So starting out with energy, there's obviously that's what's on everybody's mind. Everybody wants to know what's going on with Iran. Everybody wants to know what's going on globally with the economy and how it's going to affect this, that, the stock market, the stocks, what's going in your car. Everything is kind of connected to the energy market currently. So Kashop, passing it to you. You've been looking at the energy sector for as long as I've known you. You've really dug through it. Whether it's looking at oil names, looking at refiners, looking at uranium names, looking at anything in that whole sector, how it also correlates with gold miners, and gold mining, and so on. So, what are you thinking about the energy trade currently? I keep hearing it's dead, it's over. Or there's people. It's either one. There's nobody in the middle. There's everybody's either like it's gonna go, oil's gonna go to 250, or it's like oil's going to zero. There's nobody just going, hey, this is what's happening. So passing it to you, fundamentally, technically, what are you seeing out there?
So a recession is actually bad for demand, and by all indications, we are in a recession. Now, that recession, it's not being felt by the stock market, or markets are kind of complacent about it because, hey, there's a semiconductor bubble going on, there's a data center build out going on. So let's all ape into memory stocks. Let's buy some, South Korean names at $1 trillion valuations, and let's, forget about what's happening on Main Street. So that's kind of been the thinking of late. And that's the only reason that people aren't really panicked about the recession yet. But once the stock market starts to tank, once it becomes obvious that the SpaceX is a massive bubble and it has to burst, like go down 80% at the IPO or something. So once all those news starts to come out, and we're already starting to see that in crypto. So once you see this immense wealth destruction happen in a short period of time, now that's definitely going to be bad for energy demand. But on the other side of that, what we are really going to see is there's going to be demand destruction for sure, but the supply destruction has already taken place. And really, like when you look at the demand destruction and the supply destruction, the bigger picture is the supply destruction because the demand destruction is not permanent. Everyone knows that once stocks start to tank or once Trump gives the command, Wash is going to start printing money and, like they did in COVID, like that time they just printed something like $4 trillion in a short period of time. And now with the debt nearing 40 trillion, maybe they print 8 trillion, maybe they print 10 trillion. So this demand destruction isn't going to last very long because, every Fed cycle is the same. First sign of a recession, let's print more money. So
Yeah.
that's going to happen. But once you do that, how do you make up for the lost supply? Well, the supply destruction is permanent and the war is still going on. So when the next cycle takes
Wait,
off
Kashop, I
after,
keep hearing the ceasefire is here. The war is ending, and what are you talking about there? The war is still going on. I've just got to stop for a second and ask this question because I keep hearing in the United States it's over every other day.
yeah, I mean, that kind of, so the war is fought on two fronts. One is the physical war and the other is the media war. So what you're hearing is the media war, and the physical war, it just keeps going on. And it, in fact, looks like it's going to escalate. So right now, there's talk that just like the Houthis blocked the Red Sea earlier in 2023, it's going to get much, much worse in the sense that that strait is going to get blocked completely. Now, if you block that strait and then Hormuz is also blocked, then that's really, really bad for shipping flows because then all ships have to go through the Cape, and that's massively inflationary. So we are seeing more escalation, and we are going to see even more supply destruction ahead. And let's keep something in mind. So the last oil tanker or the last products that move through the Hormuz, or even last of any goods that move through the Hormuz, they probably reached their destination a couple of weeks ago. So we have had this really tight supply squeeze only for the last couple of weeks or so. And everyone in the supply chain does have their inventories, so they can draw them down. And now they have drawn them down to catastrophic levels. So if you look at the US with the SPR releases, which is the Strategic Petroleum Reserve, so Trump has been emptying out the SPR at a breakneck speed. So, in 2022, everyone criticized Biden for doing that. Well, Trump is doing it in a much worse way. And what happens is that once you drain all these supplies out, there is a point to which you can drain them out, because once you really send all the oil out, then there's going to be a big pressure gap that's created in these salt caverns, which means they are going to internally collapse, which means there will not be an SPR, there will not be, let's call it a tank. There won't be a tank left to refill. And in that case, what happens? Well, don't draw it down to such catastrophic levels. So we are already getting to that point, and at that point, that's it. There is nothing else. There are no levers to pull, because what can a central bank do? They can print money. What can a government do? Well, if they decide to, they can manipulate markets, they can manipulate the crude oil contracts, they can put out fake news, but that is about it. You cannot bring supply back online. And sure, US invaded Venezuela, got their oil, and that's kind of helping a little. And then the Jones Act was scrapped, so you can have foreign tankers loading oil or products and moving them from one US port to another. So you have all these levers to pull, and guess what? They have already been pulled. So what's left? Pretty much nothing except really ending the war, declaring a truce, and letting the supply chain rebuild. And I honestly cannot foresee that happening. So, which means we are going to be in for supply destruction outpacing demand destruction. And when the Fed prints money in a crisis like this, all that does is make that inflation worse, because you're not allowing that demand destruction to happen, because you're trying to prevent a recession. Whereas what we really need right now is a full clearing out of all this AI bubble capex, like the TMT mania. Just get rid of all of it. Let the economy heal. Let prices find themselves where they are, which is pretty much the Austrian solution. And let the Fed get rid of all the mortgage-backed securities and all the 30-year duration treasuries that they have on their balance sheet, so that price discovery can happen. But of course, that's a pipe dream. That's never going to happen. So what we're going to get is one intervention after another, and eventually it's going to blow, and we are going to see oil prices head so much higher. We are going to see gasoline shortages. We are already seeing aviation fuel shortages. It's going to get worse. And this is the first year, in fact, since COVID, that number of people passing TSA checkpoints has decreased. So airline traffic is already coming down, and you can see that happening. But it's going to get much worse. And if the Fed prints money, I don't know what happens, but probably we're going to see, the way semiconductors move. We are probably going to see oil stocks move. We are probably going to see everything move, including commodities. And all the commodities you would have left for dead, we are going to start to see them move. Like 2022, we had this huge run in cocoa, and I can really see a lot of commodities imitating cocoa if the Fed starts printing money in this environment. So, long story short, I think the best case scenario is we get demand destruction and the government just steps aside and lets it happen. But since that will not happen, we are going to get demand destruction followed by intervention, and that's going to be mega bullish for energy.
Yeah, cause shop, I'm gonna try to see if I can figure out what's going on with my internet, because I'm hardwired and it's acting funny. But before I do that, I want to drop you this one idea here. So, talk about copper, Latin America. What's going on with the copper miners? What's going on with the Mexican peso? These correlations are really, really good. Rick brought this chart to me yesterday, and I thought it was really good, something you and I could talk about. So, what are you thinking about copper? Places you want to be in that market, and I'll be right back.
Sure. So I do own Hudbay, and I'm up, I think, something like 150, 200% on the stock, so I can talk about it. Um, I think copper miners, you have to be very, very careful here. So if you bought Freeport and then they had that big disaster at their one of their wall slits, so if you bought Freeport and you held through that, well, I don't know what's going to happen next. Is the capacity going to come back online? Probably not. Now, Freeport may still rise with copper prices, but it's not really on the fundamentals of the company per se. Now, it's the same with Ivanhoe Mines. Like they had this big earthquake and a big disaster there, and that mine is not going to come back the way it was earlier. So that's really the case with the copper miners. You have to be really, really careful what you pick. Now, of course, you use an ETF, it's going to get easier. But broadly, in an environment like this, what you want to see is not just copper going up. Sure, copper is at $6.5, and that's great. But what you want to see is the gains in the price of copper outpacing the gains in their input cost. So you want to see, let's say copper goes up 10%, but labor inflation goes up 30%, diesel prices go up 50%, power prices go up 50%. Well, then, you really shouldn't be buying the miners because they're not going to be able to keep up with the input cost inflation. So they're going to see lower margins, even though they're going to see higher revenues. So in that scenario, you should be avoiding the copper miners. But it really depends on what kind of mine you're buying, what kind of stock you're buying. So you have to do your research. Now, as for the peso, I don't have a view on the peso. I'm neither bullish nor bearish on it, mainly because it's so tied to the dollar. Now, yes, you would say that in general it's going to do well when the dollar tanks, but that may not be the case because the Mexican economy, is so tied to the US economy. So I really don't have a view. So I don't want to
Yeah.
add much more to that. Yeah,
Yeah. No, I feel it. So everybody out there, if you guys can just leave me a note, is my voice okay? My something's up with my
it's
camera.
okay.
Okay, cool.
Yeah, your voice is okay. Yeah.
Okay, cool. Yeah, something's up with my camera. I don't understand what's going on. But anyways, just kind of want to walk through the rest of these because there's so much kind of interesting about that one and that correlation. If we're looking at copper in Mexico, this is a very similar chart. These are two charts that are exactly the same. And when Rick brought this to me yesterday, I was like, yeah, and it makes sense. Like, it is a copper producing nation. Not to mention, most of the time when you see copper go up, it is kind of saying something more about global growth. So if you see something saying something about global growth and the dollar is in a weak environment, as you're seeing in this period of time after 2000, the dollar was in a weak environment. The dollar weakened or wasn't that strong at the beginning of the after the 2008 crisis, and then the dollar strengthened shortly after that, and that was the end of basically emerging markets, energy, and so on for a long period of time. The dollar kind of topped out for a little bit back in 2020, went down for a minute, and then it bounced up real fast at the end of 2021 into 2022 and during the Russia-Ukraine crisis. And so you kind of saw that big pullback in emerging markets as well as copper. So all these Mexico copper looks exactly the same during that period of time. And then it bottomed out. That would be October 2022. And then they started all kind of moving up, had that big pullback last year in a lot of the emerging markets, actually a couple of years ago. That's 24 now. And then they all kind of bottomed out right when the dollar topped in January 2025. And then they all kind of moved higher together. So I do think that this is kind of an interesting correlation. And I bet that Mexico looks very similar to U.S. copper. And once again, if you're looking at this Kashop from the angle of mining, are you looking at any gold miners? I know the answer is already yes, but is there anything specific that you can give away, that you're looking at in Mexico that's like a gold miner, copper miner, some sort of producer of metals in that area that you're thinking is an interesting place to be currently?
So I wouldn't own. So in general, mining in Mexico, it's kind of gotten a little riskier. Now I know some people will say that although they keep talking about banning open pit mines, new open pit mines, they are permitting them. But then, do you really want to take jurisdictional risk on top of all the other things that can go wrong in mining, as well as the rising input costs? That's not something that I'm comfortable doing. And recently, we saw what happened with Vizsla Silver. It was a high flying momentum stock. And then news came that they had issues with the cartel, and then boom, it's like down 50% in no time. So when you're buying Mexican stocks, you really have to pay attention to the risk factor because yes, sure, it looks great. Everything goes up when metal prices go up, and then you have a cool story, and you have some pretty awesome promoters sitting in Toronto and Vancouver, who will tell you why you should buy this stock and what the upside is based on some preliminary economics. But it is not for me. I am looking at stocks, but I'm looking at them in safer jurisdictions. So I'm looking at Canadian and US companies. So nothing in Mexico, nothing in the other parts of North America, or not even in Central America right now.
Okay. Yeah. So, the let's see. I think I did bring apart freely mentioned. Sorry to give everything away, but I did want to bring this up. So, Freeport McMoRan, I know you've mentioned the fundamentals plenty of times, and talking about it. Currently, like a lot of basically most of the technicians are interested in it currently for obvious reasons. So it's something that I am not currently long. I am long via the COP or the XME ETF. So it is in there, but it's not even the biggest weighting in it. So why don't you like FCX? What's going on with it? Because I know there's a lot going on that a lot of people don't understand yet. And it's not that I even hate the name. It's just there's a lot of names to dig into in this space. And this is one of them that like I could take it or leave it. So I want to pass it to you. Looking at the fundamentals, you mentioned last year there's events that happen with the company. There's earnings events that also happen with the company. So what are you thinking about FCX currently?
So I owned the stock. It was one of my favorite picks in the copper space way back when the bull market started. And then the news came that they had this mudslide event in their biggest mine. And I was concerned, but they said it wasn't in the main operational area. It was in one of the areas that they were developing for future mining. So I was like, okay, let's wait it out. And then as the news came out, it just got worse and worse. And I sort of have a little bit of PTSD about these situations because I was long a company called Victoria Gold when they had this heap leach disaster. And so I thought, let me just get out of harm's way. And I got out, booked my win. I think it was probably a 50-60% win. And then the stock went down for a while. And then as copper went up, the stock started going up. And the news started getting worse. So that was sort of a divergence. Like everyone was treating it as because the company themselves said, by 2026, they're going to be back at 70% capacity. And by 2027, they're going to be back at full capacity. And markets were like, yeah, okay, let's give them the benefit of the doubt. For me personally, I did not want to give them the benefit of the doubt. And if you look at, for instance, Southern Copper had the exact same momentum. It did not have those problems. So if you're going at it on a purely technical basis, why would you pick FCX over SECO? So that was my thinking. So I never got back into it. Plus, I had other copper miners in the portfolio, mostly Taseko mines, which they recently got a new mine online, and the market wasn't giving them credit for that. So I pivoted to that. And broadly, I would not get back into FCX right now because the issues are still not solved. So, yeah, sure, the chart looks great, but when the fundamental issues are not solved, why would you buy it? And it's the same answer that I have for Ivanhoe as well, in case someone's curious, because yes, Friedland is a great promoter, and what they have done is incredible to go into the DRC and build a mine. It is absolutely incredible. Hats off to them. But then once you have a seismic event, it is really, really hard to get that mine back up and running. And I have seen this. I've been in the space for over a decade, so I have seen this enough times, and I would not want to take those risks, especially when you have these other copper miners where you do not have to take that risk. So, to give you an example, so First Quantum had issues in their biggest mine, which was in Panama. The government said, let's shut it down. There were a lot of local protests. They blocked the roads and said, the number one issue for our country is shutting down this mine. And eventually it happened. Now, First Quantum had a big drop back when that news came out, and then it started going back up. But would you buy that stock? For me personally, I would not buy the stock. But yes, a lot of people who did buy the stock made money. But it's a sort of decision, it's like with a burning match, you run through a weapons factory. Mostly you'll come out okay, but you never know. So that's just not something I'm comfortable doing.
No, I agree. I mean, it's, and once again, you always have to figure out what you do as a trader. That doesn't mean, you know, for me, I'm a guy that sometimes I'll look at things and fundamentals will look fucking terrible. And, you know, but I will put on the trade because that's the way my signals work. Doesn't mean it's always right. Doesn't mean it's always wrong. Sometimes the fundamentals catch up. Sometimes they never do. You never know. But just figure out the way you do things and what you're comfortable with. Kashop's comfortable sitting and looking for other things. I'm not really a stock picker, so I really do mainly go, like, I do have some stocks, individual names, but mainly I stick to the ETFs. That way I'm kind of hedged from what could possibly go wrong. Meaning, you know, if there's a crazy earnings event or, you know, something happens with FCX operations and so on, I'm not going to get hit like other people because I'm in a diversified ETF. Whereas if you just have one, that's usually a bad thing. And also something that I know Kashop would say as well is the way you always want to look at it is you have different. If you're going to build up, like, let's say you have a bullish copper thesis and you're like, okay, I really like copper, I want to own things in copper. You wouldn't just buy FCX and walk away. That would be something you just wouldn't do. You would buy at least 5 names. So you'd buy these 5 names, and then if one gets hit very badly, like, it's not going to kill you. So, you know, buy 5 names if you're long something. And this is with anything in this space. Mining is tough. It's not as tough as something like, it's not like venture capital, but where it's like, hey, this is going to 0 or 1 million. It's like, no, it's sometimes you're going to take these like weird hits from time to time. Sometimes earnings are going to be big and smash you in the face and you're not going to be ready for it. Sometimes it's just going to, you know, news is going to hit the wire and you're not going to be ready for it. It's just how it goes in this space. So understand you want to be diversified going forward. And so I wanted to talk about the, you know, crude oil. We got a good question here from Tim. And so the question from Tim, basically, I'm seeing chatter about trading the SPR calendar spread, short CL July, long CL August, September, etc. Does that potentially lead to a squeeze contract roll 2022 run? I'm thinking he's saying like 20 and 22, like 20 through 22. So this is a tough one. Once again, it's like you can go on there and really just go nuts. You know, you can think that this is going to happen or this is how these spreads are going to work and so on. Sometimes it always changes over time, meaning you know, sometimes the front month will go up more than the December contract. Sometimes the December contract will hold up better than the front month contract. This is a really hard way to trade an individual product. I really like spread trades when it comes to something like, hey, maybe I'm short crude oil, long gasoline. That actually works really well. Maybe I'm short soybean meal, long soybean oil. Those things work really well because the crush spread on soybeans and so on. So like you get an understanding of how these assets kind of work against each other or with each other. This one just, I don't ever anymore. I mean, I used to. I don't ever anymore take something like a December crude oil and go, hey, I'm going to short this and then be long, you know, the front month contract or something. I don't mess with that anymore. So, you know, I'd say the best thing to do is just kind of stay away from those types of trades currently because you're not going to know what month is going to get hit the most. It's kind of like saying, like, if December crude oil, if I'm long December crude oil, which I am, and I'm also long the front month contract. Let's say, I think it's still in June currently. So if I'm long both of these, actually it'd be in July now. So if I'm long both of these contracts, I don't know which one's going to go up more, but I know the front month contract is going to have a lot more volatility, meaning if we roll all the way up to those old highs in that front month contract, like that's going to be a much bigger move, but the more stable move is going to be in December crude oil. So I still think the idea here is not to go too crazy on thinking about spreads, but continue to be in the longer dated contract if you're a futures trader. Also, USO right now, it's very rare that I ever recommend an ETF for commodities. But if you're talking about USO, you can basically go, okay, USO, they continue to get paid as they roll the contracts forward. So they'll continue to get paid going forward, which will actually enrich USO, make USO actually worth a little bit more money. And so it might actually outperform that front month contract going forward. Going back to 2020 in April, USO stopped buying those front month contracts because they got hit pretty badly from that. So now they roll their contracts a couple months out every single time. And also the curve is in backwardation, meaning you're getting paid going forward. If you look at this chart on the left side, that's a front month contract at 92. And then on the right side, you'll see the December contract at 82, meaning that as you're rolling these contracts forward, you're getting paid to do so. And when you're getting paid to do so, one, that's usually very bullish for the product, but two, that also incentivizes rolling. So USO actually is going to do very well during this time frame as long as the curve stays the same way. So Kashop, anything to add on that? You know, you've mentioned some things about, you know, I'd like to come back to you about the war ending idea. You know, you mentioned a while ago, if the war ended, you would short crude oil in the short term. Long term, it might be even a buying opportunity. So are you still thinking that currently, now that this war has gone on a little bit longer, like that was a month or month and a half ago? So what are you thinking now?
So that was particular to the situation where you had something like 200 vessels blocked within the strait, and they had oil loaded. So if the strait were to open, then they would reach their destination, give it 2 weeks, and then the shortage sort of would be abated. So that was a specific situation when we had so many ships on the water, just waiting to get out. But now what we are seeing is actual supply destruction. So even if the war were to end tomorrow, that's not going to be the case. And I think we just have to expect permanently higher prices. Now, what happened after the shale war was we sort of expected 60 as the average price, average long-term price. And then after COVID, it became, sorry, it was like 40 around 2014, 15, and then it became 60. And now I think we'll have to price in 80 or $100 oil being the new norm. Now, that's actually not high if you think about it. So in 2008, right before the world economy tanked, oil was at $140 a barrel, and the Fed has printed something like, they have expanded their balance sheet by 10x since then. So if you look at that price, then the peak price really should be somewhere around $1,000 a barrel, which is ridiculous to think about it. But that's like if you say the Nasdaq is keeping up with the Fed balance sheet and gold is keeping up with the Fed balance sheet, then why not oil? Well, it is not, because we had a lot of excess supply for a long time, and now that supply is gone. So where does oil go? I think it goes permanently higher, and I would not do the trade where which I mentioned, which was shorting crude and going long the crack spread, going long the refined products. So I would not do that trade right now. Even if the war ended, I think if the war ended, I think all this manipulation that's being felt in the futures contracts will end, and the trade would be to just short these semiconductors, which are in the bubble, short these Korean equities, and just go long oil and pretty much anything tied to energy.
So that brings us to lumber. So I'm interested in this because Kashop's brought up the short idea, and we got to do a bull bear episode coming up, because I'm still bullish on semiconductors, even though I see what's going on in semiconductors. But I'm also a guy, I'll stay bullish in a bubble till the end. When the trend ends, I will be out. And I have a way of quantifying that. Not everybody does. I remember thinking about this early on, Kashop, in trading, which is what is this magic? I think it was in Hedge Fund Market Wizards, Cole Moshe talks about trading bubbles. He talks about trading bubbles and being long during bubble situations, and how he can make so much money in a bubble. And Schwager goes, how do you do this? He said, by definition, you can't make money in a bubble. And he said, well, you can, and you do it this way. And he would talk about like this. He would say you'd buy call options until the trend breaks, and they'd be like, well, how do you look at the trend breaking? And really, nobody ever quantifies that. They just go, yeah, when the trend breaks, or yeah, ride your winners and ride your winners, cut your losers, and so on. So nobody ever quantifies that, but really, that's the key for everybody in trading, is to figure out how do you take advantage of that. because everything you're going to trade that's going to make you a lot of money over time is going to be a bubble. I hate to say it, like silver, Kashop and I were in silver. It was a bubble. Kashop and I were in Bitcoin during the craziest bubble in history. That was wild, like seeing that. Big crashes in the market. Like these are all ways you can make a lot of money very quickly, but you have to have a way of doing it. Some people, they trade it on the way up and they get out on the way up. Nothing wrong with that. There's people who ride trends like me, and then when the trend breaks, and you can quantify this using moving average crossovers, amount of day lows, whatever. There's a million ways to quantify a trend, but you have to listen to however you're doing it. Like however you're doing it, if you look at momentum and you're like, okay, there's the rate of change is at crazy all-time high levels. I've never seen this before in history, and it's gone on for 3 weeks. If that's your way to get out, fine. You can do that. If you look at it like me and you're like, well, I have no idea where this trend ends, but then when it rolls over and it hits my either stop loss or it breaks this specific level that's based on some indicator, Bollinger Band with some day low, something, then you get out of that. So you have to quantify this one way or the other. And so for me, it's like semiconductors are still in an uptrend. I'm going to be long, but at the same time, like I know what's coming at some point isn't going to be pretty. But I also know that with everything I trade. We didn't look at silver, and Kashop and I didn't get on here every day when it's over, $70 and say, hey, this is going to happen forever. We're ready for a pullback. Kashop would talk about the move being parabolic. I would talk about the move being extended, but I was going to hang on till it moved a certain way. Kashop had a different thesis on it, why he was holding. So, you just have to figure out the way to quantify that. And you don't have to trade like me or Kashop. You just have to do it for yourself. And so we'll do that at some point, maybe next week. We'll talk more about why we're bullish or bearish on things. I want to talk about lumber. Go ahead, Kashop.
Yeah, but to be clear, you've been long semiconductors since 2023, so you caught an insane move, and it doesn't matter if the SOX goes down 50% and you'll still get out the profit. And that's not really the case for most of the guys who have YOLO'd into this trade. Like, I don't think people are even talking about semiconductors in February or March. I think February, probably we are talking about the Max 7. March, it was the war. And even April, it was pretty much about the war and, the day-to-day news flow. It's only now that people have got interested in semiconductors, and it's pretty much right at a parabolic top. So it's going to be different for a lot of people compared to the way you did it, because I remember when you got into the trade, the Nasdaq was probably up 20-30% from its lows. The news flow was super bearish because we just had a couple of bank failures, and we were talking about First Republic going under, and we were talking about the Fed rate hike cycle and all that. And that was the time you got long. So, your positioning, it's not really going to reflect what the other participants are doing.
Yeah, but that's the hard thing about it. It's like, it's going to sound crude, but it's like, I can't, and it's almost a fuck 'em situation, because it's like, I can't make you trade the way I did. Right. Like I have a service. You guys can see how long ago I put on positions and so on, and be involved in that. I can get on here and talk about it. But at the end of the day, it's always, am I recommending buying semiconductors today? Like Kashop said, no, I'm not. I'm not going to say, hey, let's start buying these new highs here. It's all about how and when you get into these positions, how you trade them. But once again, I'm not going to hide you guys what's in my book. If I'm talking my book and I'm talking about semiconductors, I'm talking about silver or whatever, I will tell you the good and the bad. So you guys can know everything in there and when it's going to get hit or not. So I think that's always really important. But we'll definitely have to do a talk on that just to see what, because I still think the market possibly has more to go. Because Shop's looking at, we're in a bubble. He probably does. I bet you do also think there's possibly more to go, because once again, in a bubble, you can't ever pick a top. But if you look at it and you go, okay, well, this possibly has more to go, but this is possibly going to turn over. That's something we should talk about. So that'll be fun. The question was, does strategy work on biotech stocks? Strategy works on everything. It just depends on what fits your lifestyle, the way you trade, like that really is everything. And not to mention market cap. I wouldn't do much on, if I'm buying, penny gold miners, I'm not going to say my strategy is going to work very well. It can, but it's just not a thing that, one, it's not a thing I do. It's not a thing I've ever back tested. It's also, that's based on a lot of things that's going to be mainly news flow. Something that's worth, 5-10 cents, is could be worthless soon, or it could go up a lot. But it's not really based on any magical technical level most of the time. It's mainly based on what's going on. Did they get bought by some company and so on? And when you understand those things, like a guy like Kashop, that's going to be more his wheelhouse. But if you're looking at biotech stocks or any of the large cap names, even most of the small cap names, yes, it will work on just about everything. But looking at lumber, so this is one that I thought was kind of interesting. And let's see what time. Well, so after this, we'll get into the bubble stuff. But lumber, thought was kind of interesting. My buddy Andy brought this up. How can I kelp on Twitter? So looking at this one and seeing just this level and seeing this thing has been chopping around for so long, it has been a miserable trade. And I love trading lumber. I've traded lumber many times over the years. I always think it's great, but I haven't got a signal for a long time because it's just gone nowhere, basically all of this year. So Kashop, looking at it, what do you think about lumber, the market? Because this would also be saying something that I think is very counterintuitive for what's going on in the world and what people actually think about the market currently, which is the fact of lumber would be saying growth is coming globally. Now, possible in certain areas. I think outside the United States is growing a lot faster than inside the United States currently. The war situation probably put a damper on a lot of that. So what are you thinking about lumber, copper, the idea of global growth? Are people building stuff? Like I'm in the United States, I'm not seeing nearly as much buildings going up or anything really happening here. But I know globally last year I was seeing a lot of that. What are you seeing? Are you seeing things put on hold because of the war? Are you seeing people still building? Or is it something that's just like, hey, we're kind of heading into, and your thesis might be heading into some sort of global economic downturn?
So if you look at number of sawmill closures, like now that we have Claude and all these other AI models, you can just ask them to compile the data. If you look at the number of sawmill closures, it is just a steady trend. Like every year, practically every other month, we get the news that one or the other sawmill has been closed. Now, that's a lot of supply destruction that's taking place. And I don't know about the commodity per se, but if you look at the stocks, so most of the stocks that you would trade, it's 80% Canadian lumber and like 20% US lumber. And the Canadian lumber category is very, very interesting because it's deep value. The amount of money that they have on deposit, so there's a sort of tariff war going on between the Canada and US in terms of lumber. It's been going on for like a decade, and the amount of duties that they have paid that they will be eligible to get refunded, that has now become a significant double digit percentage of most of these companies' market cap. Now, the question is, will they ever get that cash back on the balance sheet? And will there be enough demand to offset? Will there be enough revenue for these companies? Now that they are closing all these sawmills, will they ever be able to rise up and become a growth stock rather than just a deep value stock? Because you really don't want to buy a deep value stock, the last buggy whip manufacturer to go out of business. Sure, they make great buggy whips, but you would not buy that stock. So you really would not want to buy those stocks in that situation. But if you do see even a little bit of growth, then I think they are going to be in for a tremendous repricing. Now the question is, it's like picking Japanese equities. So if you pick Japanese equities in 2014, 15, they were cheap. 2016, they were still cheap. 2018, they were still cheap. Now, how long are you going to sit on a debt trade where you know absolutely that these stocks are cheap, but they are not moving? Whereas if you pick Japanese stocks 2 years ago, you're probably up something like 50%. So the timing is everything. And with lumber, I'm not certain of the timing, but it's definitely a category that I'm keeping a close eye on.
No, I agree. I ran through some charts. You guys may have seen some stuff we didn't get to cover, but I wanted to get to this. So looking at, when bubbles burst. So we're looking at the NASDAQ basically from 2000 all the way to 2012. What do you mean, Kashab? Technology never goes down. I don't understand this chart you just brought here. The Nasdaq should have been hitting all-time highs probably a year after this. The Fed didn't lower rates to zero and didn't do unlimited quantitative easing back in 2001. What's going on here?
What this really shows is like, so the Greenspan era is when we really saw the Fed get very interventionist. And even with that kind of expansionary monetary policy, what happened was once the Nasdaq bubble burst, the money went elsewhere. So if you look at what happened in the period from dot-com to the global financial crisis, yes, US stocks went up, but guess what? Global stocks as a category went up even more. Like you could throw a dart on the world map and pick a country which would outperform the US. And that's really what happens when bubbles burst. So the capital rotates, and you might think, yes, the Fed is going to print money, and all these big tech companies, they're going to keep adding trillions to their market cap just because you're going to see trillions more in money printing. But that takes a long time to play out. And now the cycle's definitely going to be shorter, but it's still going to take a long time to play out. And this is not just US, I don't want people to get the impression that I'm dunking on the United States for some reason. So if you look at the next chart, that you can say the same pattern play out in China as well. So the Shanghai Composite Index, they had a big bubble, like I said. So 2000 to 2008, that was really the era of Chinese equities, because they had the secular growth story. They had joined the WTO. They were becoming an exporting nation. They had their currency pegged to the dollar, which everyone at that time said was a really good thing. And then you had this massive top, and then they never really recovered. 2014-15, there was a tech bubble, and even that did not get anywhere close to the 2007 top. And now we are sort of starting to see Chinese equities recover, but it's still not even close to the previous 2015 top, and long way from the 2007 top. So this is what happens. You can have an economy that's growing, that's lifting millions of people out of poverty, but when valuations get out of whack and the bubble bursts, you're not really going to see the same bubble reignite for a long time. And there are reasons for it, because bubbles are not about fundamentals. Bubbles are about the technicals, the sentiment, the animal spirits, the sort of euphoria. And once people have been hurt, they really don't want to get back to doing the same thing again. And this is something that we can even see with crypto, with these accelerated cycles, where now that a whole generation of investors, has grown up thinking that betting on Polymarket and buying all these meme coins and leverage long Bitcoin, and there's even a guy who's taking out credit card loans and posting about it because he's using that money to buy Bitcoin. So all these crazy stuff, people have normalized it, but then once the cycle ends, it's not going to reignite for a long time, and that's pretty much what we are going to see soon. So let's just go through the next slide, and then we can end it there.
Okay.
So now what we are seeing is Korean stocks doing pretty much what the Chinese stocks did during the 2014-15 bubble, and what the semiconductors are doing today. Now, this really does not look sustainable just based on the angle of the chart. And when this ends, you can be pretty sure they're going to be in for 5 to 7 lost years at least, because that's how long it takes for memories to fade. So the question really isn't about should you hold through the correction when these bubbles burst. You really shouldn't, because yes, they may do well over the long term. And here's the interesting factor here. The Nasdaq Composite, if you bought the very top during the 2000 bubble and you held it until now, you made a great return actually. But would you have held it for that long? No way. Absolutely no way, because the news flow was bad, and then you had all your peers thinking, hey, you're an idiot, you're still holding on to these stocks. And then out of the trouble came Amazon, Microsoft, a lot of these giants, which more than made up for the 99 losers in your portfolio. But these trades are really hard, which is why, when bubbles burst, don't hold on to them.
No, I agree. I think that's the key is, too many. It's kind of a, what was the one Soros quote, when you God, I forget the way that quote went. That was a good one. You know what I'm talking. You know what I'm talking about, where he talks about bubbles and how he rides them and then he quietly exits them right before the end. Can't remember that quote right off the top of my head currently, but that's
Yeah.
kind of the idea is how do you exit this before the end? You know, if you're looking at this one right here, how do you exit this? Well, once again, it's the reason why there's a difference between trading and analysis. Like as an analyst, I can get out here and say Korea is bullish and then South Korea is going up, and I'm like, see how right I am. But you know, what do you do during these periods? What do you do during this period? What about this one? And where we're currently at, like, how do you trade it? Trading it's completely different than just saying, hey, this is going up or down. So trading it might be, if you're shorter term, this might be too much of a loss for you, and you might have gotten out of your position right here. If you're midterm, you know, this might be a situation where you get out. Your long term, this might be a situation where you'd get out. So you got to figure out how you're going to do that. How do you really ride the whole thing? Now, once again, it's simple. It's as simple as going, okay, this is where I got out. Let's say this is where I got out, and then maybe you get back in up here. So many people won't want to do that, but it's the way you safely trade is not just saying, I'm just going to hang on to this thing the whole way and figure it out. Because when this thing starts crashing and you go into a bear market, like Kashop said, this might not come back for years. I mean, even like 21 all the way to 25 was a pretty devastating run for your portfolio. I mean, nothing was happening there all the way from what 80, 90, between 80 and 90, all the way down to 45, 50. I mean, that's not what you want to do as a trader ever. And that's the thing. Like people will be like, well, I'm, retiring or whatever. I'm going to hang on to this, emerging markets or whatever for the next 30 years. Fine. If you're retiring and you really want to do that, great. But still, that's still not a really good course of action. And what we're talking about here is trading, which is always a good course of action. But even as an investor, you don't want to just hang on to things because you think it'll go back up again. You never know the future. Also, the way some of these are weighted. What if semiconductors, I keep hearing technology is deflationary. So I hear this every day. I think most of that's bullshit, but that's also, let's talk about technology being deflationary for technology. What if semiconductors kind of go out of style? What if something happens where, that's not exactly the hottest stocks in the market anymore? What happens to a country like South Korea at that point? So that means their stock market is probably not going to go back up. Or let's say the biggest name in there, the one company that I think there's a couple huge names in semiconductors that basically runs this whole index. Let's say those names take a hit and they don't come back, and some other country, Taiwan has a bigger name that starts to take over that area and so on. What happens to the EWY? Well, it's going to go to shit. It's going to be stuck in what Kashop's talking about in a lost decade. So once again, it's just get an understanding of like, I'm a person, I like to ride trends. I am happy with this move up, volatility, everything. But I also will not hang on when this thing's really breaking. I'm not going to hang on. And so Kashop brings up a great point. So, all right, guys, we're going to hop. We will see you guys next week. Kashop, thanks for bringing those charts. That was fun. We should do like history lessons on stuff quite a bit more. If you guys want that, definitely leave it in the comments. Make sure to follow Kashop286 on Twitter. I am Jason, and so this is AAO Research. Make sure to hit that like button, subscribe. Make sure to share the channel if you guys can to anybody who needs it, and we will see you guys next week.
Thanks, Jason. Bye, everyone.